Private equity, it's just trying to go to wherever the easiest return is going to be.
If you're going to sell any part of your business to a private equity group, you should probably be looking at PE groups that have done deals in your sector.
VCs, if they invest in Series A, they're going to be senior to the founders because the founders are going to be common.
VCs really want to hit 20x's, right? Like monopolistic outcomes that can return the whole fund. Private equity, if you return a 2x, you're pretty fucking smart. I could sell Ridge for $40 billion tomorrow as a top line valuation number, but the deals would be horrendous, right?
You're not going to get the money out without a structured deal. There is no other deal.
Welcome to the Operators Podcast. It's me, Jason, Matt. Mike's on vacation. Jason's back from vacation. We're going to quiz him about everything M&A. The rumor is he was a banker for over 10 years. Let's see if he remembers any of that stuff. Let's get into the episode. Thank you. Postscript, Ceres Analytics, Rich Panel, Northbeam, and the premier sponsor, Fulfill. They are paying for this content. So you can listen free. You just got to sit here, listen to the ads. And when you're ready to buy those softwares, they're available. The code OPERATORS will get you access to unlimited free whatever of whatever they're giving you. So thank you, podcast sponsors. Thank you, podcast listeners. Join E-commerce Fuel. We moved our Slack group over there and we have a newsletter. Okay, let's get into it. Meetab. You and I both use and love Fulfill. You have an extensive history of using other ERPs. So, in your 50-year career, what is the worst implementation story you have heard of?
Worst implementation story is one time we implemented a really horrific ERP called Fishbowl. And the thought process there was, hey, this is slightly cheaper than some of the other big competitors. This company's a little bit smaller. Maybe it's a good idea. And that was not a good idea. It was a very bad idea. It couldn't handle orders. Like if you did over, I forget it was, if you're doing over like 100K a day, it would basically break, which is obviously not that hard to do. So you'd break the ERP really badly and there was no real solution for it other than turn it off and then turn it back on again and manually push the orders through. And that was the worst ERP ever. So we ended up switching off of that pretty quickly.
And you switched to Fulfill and you've never been happier. Let's talk about implementation real quick. Things can fail, right?
Yep.
Going to market can fail. You can have a failed process. It's because it requires so much work. You have to put work in to set up your ERP. I wish it was one click, right? But ERPs need to know what your business looks like, where you make stuff, the cost of goods. Your accounting team has to commit to using it. So there is an implementation curve. I have heard about people who spent $500,000 to set up NetSuite and then they have a failed implementation.
Hey, don't forget about the bonus fee that you get to pay Solido.
Right. Yeah. And NetSuite's so hard to set up that they have a third-party firm you have to pay. I mean, everyone pays third-party firms to set their thing up. So look, Fulfill, you're not going to get that. They're going to commit to making sure you're using the features you pay for. They will hold your hand all the way through that process. If it takes 12 months to get the full suite of features, they're there to help you support. I think the biggest scam when it comes to ERPs is the third-party implementation fees. For people who don't know what the hell I'm talking about, you pay for a software and then you have to pay other people to teach you how to use the software. Am I getting that right?
Well, and build out quote unquote custom functionality, but that functionality isn't really something that should be custom. And often what'll happen is the guy that sold you the ERP, so the guy on the sales team, he doesn't really care whether or not it's the right product for you. And I don't think they're actually measured on if a customer churns after, right? So they don't care. They just want to max out their commissions. So what they'll do is they'll tell you the ERP can do something that it can't, or they'll kind of bend the truth a little bit. So let's say something like, it can handle 1 million orders a day, no problem. That's not true. If the orders have a lot of kits in them or something, it'll break functionality of the ERP. And what'll happen is you'll end up on there and you'll be like, oh, I need this critical functionality. I thought I had it. You're already knee deep with the implementation. You've already racked up 6 figures in fees. And then they'll say, oh yeah, just go ahead and hire this third party to build you a custom solution there. And you're like, well, this shouldn't even be custom. But now you're stuck paying another 6 figures to another company for help building out a custom implementation.
Yeah, and it's like, I'm going to pick on NetSuite. It's from like 1993 or whatever. And
that's when I'm born.
Yeah, exactly, dude. It's older than us. Like, do you use any technology that is older than you are, right? You should just use a modern ERP. It's not going to be easy. You have to commit your team to using it, and they're going to want to go back to spreadsheets, right? But with Fulfill, there's a non-failure implementation guarantee. They will make sure if they sign you as a client and they take your money that you are going to commit to using this thing, and they will push you across the finish line. So you got to bring, probably you got to take the ball 49% of the way. They'll take it 51% of the way. Where if you use a NetSuite, they are going to take the ball negative 15% of the way. Then you got to bring it all the way there with third-party support.
I'll give you a good example too. Like we just implemented the production module at one of our brands recently, and they did such a good job that we were able to fly one of our teammates from India over, and he largely handled the implementation himself. Like almost no C-suite involvement, and it was just him, our production manager, and then one of the ops guys. So it was like 3-4 guys just implemented the whole thing. And that's for an op with like 120 employees doing manufacturing, really complex kitting work, et cetera. Not fun, very labor intensive. So that was super cool to see. And I think we're already going to save, what's the savings? I forgot what it was, like 1% of revenue was the equivalent, or 1.2% of revenue. So pretty, like you look at that, that's a lot of savings, right? For something that we could do with one of our employees that we flew over from India. So dude, super awesome.
If Fulfill works for the gremlins of the world, like me and Meetab, and it works for,
well, I prefer a cockroach.
Okay, the cockroaches, the gremlins, the goblins, it can work for you too. So big Fulfill supporters, here to help with whatever you need. Thank you for supporting the Operators Podcast. They're doing webinars to help you learn how to do ops better. Thank you so much, guys.
We're talking about Jason's epic Italy vacation with his family. It was his dad's 80th birthday.
Yeah, dude, I want to hear all about it. I'm sorry I missed the first 1 minute. So what happened, bro?
So I rented a villa in Montalcino on the Rosewood property for 6 nights. We went a couple nights to Rome first, and it was just like over the top nice. A 6-bedroom villa. We had like chef come in 2 nights. We had a mama and villa is this thing that they do where they basically send you a woman Italian lady who like makes breakfast, cleans the place all day, is at your beck and call all day. And then there's like a cleaning crew that comes in. It was over the top good. It was so good. And my dad was over the moon because all he wants to do is spend time with us. I'm the only kid, so I'm in charge. And so my Jake and Zoe came. My wife Lexi was there, and my mom and dad, and the 6 of us had 6 nights in an epic like 6-bedroom villa with a view of Montalcino in the background, with our own pool, and it was like, yeah, it was great. It was hot in Italy, but other than that, it was literally perfect.
Dude, yeah, I hear that there's no AC or whatever. So even in this villa, was there any AC?
We actually did have AC, but it's funny, like the pros of Italy, right? Everything is absolutely beautiful everywhere. I mean, it's just everything is epically beautiful. You turn around, the next thing you see is beautiful. And the food is incredible. And you can actually, if you're smart, you can eat on a budget in Italy and eat amazing. Yeah. Like I went to one dinner, I forget, in Pienza or something for 6 of us. It cost me like $120.
Yeah, dude.
For 6 people, with a couple of glasses of wine. But it's hot. Yeah, they don't understand. Like they have AC sort of, but like I don't think continental,
not like we do.
Continental Europe, yeah, it just doesn't work as well. Or when it's 95 degrees out, it's just really hard. There's not enough power in the AC to get things cool. And then and the plumbing is suspect. It's just like it doesn't operate at our level. But on balance, it's definitely worth it for a week. I have no designs in buying a Tuscan villa, like in my mind. Like I will stick to Carmel Valley. Carmel Valley looks a little bit like Tuscany, and that's good enough. But it was a great trip. My dad
better plumbing and air
conditioning. My dad was honored, and we did it right for his 80th.
That's awesome, dude. It's very cool. Your kids were there. 3 generations of Panthers hanging out.
Yeah, absolutely.
Right on, man. Well, welcome back. We're going to now hammer you with questions about M&A and doing minority deals.
I love it. I love it. Well, first of all, I think the mantle has been passed to Sean as the M&A guru these days because he's written so many great pieces on it. But I'm happy to talk about any of it. Like, feel free to pepper me, or like you want to talk about minority deals. We talk about minority equity deals. We talk about debt deals. We talk about M&A deals. I've done like over 100 deals. So
yeah, I think we should. I think Sean clearly is like obsessive over this stuff. But I keep seeing more and more chatter about deals happening or people entering processes right now in my network. And I figured it was a good time to like dig into some of the minutia. So I don't know, Sean, what are you thinking? How do you want to do this?
Yeah, I mean, everyone wanted this year to be an M&A bonanza, like in January and February, right? Pre-tariff, I guess. Like the classic line you've heard since 2022 is that there's like $1 trillion of dry powder waiting to be deployed, right? And what that means is that you raise a private equity fund, someone pledges to give you money, you have to deploy that money because you're taking fees on it. And if you don't do anything with it, you will never be able to raise your next fund, and everyone's going to be very mad at you that like, hey, you took my money, you have this allocation, and then you didn't do anything with it. So they have to buy something, right? Now, we've seen a lot of consumer funds pivot to consumer services, which is like roofing companies or whatever, because private equity is just, it's gravity. It's just trying to go to wherever the best deals are going to be, or it's like water flows to the lowest point, wherever the easiest return is going to be. But there has been a lot of deals this year, despite tariffs, despite headwinds. I think consumer packaged goods is probably the hottest it's ever been. Durables is still not hot at all. If you're in SaaS, it's like kind of hit or miss. People don't really believe in like SaaS products all that much anymore. But Jason, you specifically, the question was about minority deals. Maybe you can explain what that is, the pros, the cons, and why that's the weapon of choice right now for private equity groups.
Oh, yeah. Well, look, there's a lot to it, right? Minority deals tend to have these days with private equity. Well, there's VC and there's PE, right? Like take it from there. And there's not been a lot of VC lately. We talked a lot about this and tweeted a lot about it, how there was a lot of VC investment in D2C brands and consumer brands, et cetera. And that's like VC money. I don't see it flowing there right now. I think that, Sean, would you agree?
Yeah, like there's no consumer VC, but can you explain the differences for everybody?
Yeah, well, so venture funds, they kind of take like venture funds and PE funds have different return approaches, the different investment philosophies. Like a venture fund will sort of invest, but they raise $1 billion and try to invest in 10 to 20 companies and like really look to have 2 to 3 winners out of their portfolio and just sort of know that they're going to have a bunch of losers. And those 2 to 3 winners, or even 1 to 2 winners, will return the entire portfolio and then some. And so it's not like they're not judged on every individual investment, but judged on their home runs. Private equity has a kind of a different return requirement, and they have a different sort of hurdles for investing. Like private equity, for the most part, they want all their investments to do well, and they're not looking to like have anything not go well. Obviously, some won't, but they're focused on a different sort of return requirement. And so from a minority deal perspective, they'll typically will do something where they'll add a lot of structure to lock in a return. So it almost acts like that. Like there's preferences in the hierarchy of the cap structure, but then there's also like preferential returns, which are sort of 2 different things. VCs typically, if they invest in Series A, they're going to be senior to the founders because the founders are going to be common. And they might have like some kind of small coupon or whatever that they get, minimum threshold return under their fund documents. But for private equity deals, especially the ones that you've probably seen these days, they just simply have a lot of structure. So not only are they senior, but they really are locking in a return. We have friends that, friends in the Big Dog Chat that have done these deals. So there's basically, they really do guarantee themselves a return percentage before you get paid. So that's, if you're seeing minority private equity deals right now, I think you're seeing that kind of structured deal where they're locking themselves in with a pretty significant minimum return. Sean, do you agree?
Yeah, but even more fundamentally, let's go back to the first thing. VCs really want to hit 20xers, right? Like monopolistic outcomes that like can return the whole fund. Private equity, if you return a 2x, you're pretty fucking smart, right? Like they're bringing up the gong, they're patting you on the back if you get a 2x. So if they can get 30% of a business for $30 million, and then they can sell that 30% to a bigger private equity group for $60 million, and they can do that in 2 years. That's 50% IRR or whatever the math works out to be. They're very excited by that, right?
Isn't it also true, guys, though, that VCs and PE, for at least from what I understand, they both actually have, if you look over like a 5 or 10 year period, they actually have the same target annual rate of return, right? Like they're earning the same IRR on their money, but just two very different approaches, right? Like a VC will have one company pay for their entire fund and put that 20% per year on the board or 25%. Whereas what Jason's saying is private equity will do multiple deals and they'll average out to the same 25%.
The way the math works is you want to be in the top 25% of VC funds or you lose money. And in private equity, you just don't want to be in the bottom 25% of private equity funds,
right?
And you'll make money. So it's like it is a more consistent formula, but it's also like instead of investing in Google, you invest in Joe's Plumbing in like Tuscaloosa, and you have a monopoly on plumbing in that market. So it's a great way to make money. It is very consistent, but it's not as sexy.
So what's interesting about the PE deals that you hear, one thing that always makes me laugh is when people talk about the valuation. They raised at this valuation because those valuations are almost always inaccurate because of the structure involved in the deal. So you get a lot of people that love to boast about their valuation, but that's not like they didn't buy common equity and wind up sort of in the cap structure.
So can you talk about structure, Jason?
Hold on.
You said this a few times.
So yeah, I think structure is very important, but real quick, we just have to talk about that. VC funds typically go into the company, okay? And private equity funds typically go into your pocket, right? That's changed a little bit in like 2020 when VC started giving out secondaries, but like that's really important to understand the difference is that if you raise $100 million in VC, it is almost always 90% of that is going into the company on the balance sheet. And if you do a $100 million private equity deal, they are buying the shares from you where you get the money in your pocket. It's an exit for the founders.
Yeah, well, it's primary versus secondary. That's right. The wrinkle on it is some of these PE deals, they call them growth capital deals. They're usually a combination. Well, they're often a combination where there will be some secondary where the shareholders will take money out, but they might want to put some capital on the balance sheet. They feel better justifying doing the deal that way. So it is a little bit of both, but definitely, yeah, VC is not taking money out. VC's primary capital to build a business, whereas private equity, a lot of that is original shareholders taking money out, or oftentimes there's been multiple transactions. Like in a company where the founder sold to one PE firm, and then the PE firm has a 5-year basically life in their investment, and then that's you do a deal with a private equity firm, and like there is a guaranteed time frame in which you get out, right? So that's another thing you see PE to PE deals as well.
You might remember that Ridge switched to Rich Panel about a year ago. Since then, our orders are climbing, yet support tickets aren't. Rich Panel's self-service portal now lets 47% of our shoppers solve their own issues instantly. We used to answer every single ticket with a person. Now, that one change is on track to save us $500,000 in support salaries just this year. Our customer satisfaction is at an all-time high. It's above 96%. And we're doing that with less people, with more orders. AI is all the rage. E-com operators are finding ways to leverage AI and improve the revenue per employee. Rage targets over $2 million per full-time employee, and Rich Panel is helping us achieve that goal. Rich Panel offers one of the most straightforward ways to leverage AI and improve your bottom line. Here's how Rich Panel's AI is different from anything else out there. First, Rich Panel spends the first 24 hours just learning your past conversations. Then it takes all that knowledge and creates self-guided service flows. There's no chatbots, there's no hallucinations. It is just exactly what your customers need to see and hear to solve their problems immediately after that first 24 hours. Our team saw the impact on day one. We're getting more tickets. They're being resolved faster, better, with a higher level of competency, a higher level of satisfaction, all with less people on the team. So if you're serious about boosting revenue per employee and freeing agents to do higher value tasks, book a demo, Switching is painless. They do data migration. They train the staff. Everything's handled. It's a white glove service for operators listeners. Brands like Ridge, Jones Road, Pila, Lomi, they're all already switched and they were live within 2 weeks. They guarantee 30% ticket reduction in the first 60 days or your money back. Think about that. You're going to get a bunch of customers coming to you. Q4 is just around the corner, and they guarantee 30% reduction in human tickets in the first 60 days. If that's interesting to you, go to richpanel.com/demo to book a demo. That's RICH panel.com/demo. Get started today. Thank you so much, Rich Panel, for supporting the world's #1 e-commerce podcast and being on the greatest show on earth. Let's get back to it.
So can we, I guess there's two concepts right now, Jason, that you talked about. There's a few, more than a few, but there's two big ones. The first is structure. I'd like to start there. And then the second is what you just mentioned is this, they're guaranteed to get out in 5 years. And that, like, because I think we probably take for granted how much we know about these deals, just having dealt with bankers and whatever. Jason, you've seen hundreds of deals. Sean and I talk to bankers. I've raised tons of venture capital. Like, there's so many terms that you're throwing around right now that when I look back at myself 5 years ago, I didn't know what any of this was. So can we start with, what do you mean by structure? Can you just rattle off like, okay, it's like, back up. Consumer right now, just put VC aside. We're likely not talking about venture capital. We're likely, the people who listen to this show, at some point, your likely buyer is a private equity backed something. Okay. Roll up, whatever. It's PE money. What is structure and what should founders, operators be looking for? Like, what are some of the big ones, Jason?
Well, it's basically the easiest way to think about it is it's some kind of preferred equity that has a guaranteed return. So they will it's like, maybe it's a liquidation preference, which not only liquidation preference kind of used to be like, oh, well, if the company goes bankrupt, we're first and here's what we're going to get out. But now with liquidation preference really applies to everything in a sale, some kind of sale or maybe an IPO. And so basically, if I put in 100 million, my liquidation preference might be 150 million. And so basically, right, I put in 100 at a certain valuation, but I'm guaranteed to get back 150. And if your valuation doesn't support that, like say I put in 100 million for 20% of the company, right? So that's a $500 million pre-money valuation, but I'm guaranteed 150. So if the company sells for 550, it's not a great outcome for the common necessarily, but me as the PE investor with the structure, I'm getting 150 no matter what. So you're only getting
dude. If it sells for 250, they're getting 150.
Yeah, that's it. So they basically have real downside protection. That's what structure is. Structure is downside protection with upside participation.
Yeah, and there's other forms, like they'll add in PIKs, right? So like they'll add in interest on the deal. So like they might put in 100 million or 100 whatever.
Yeah.
And that every year that 100 million earns another 12% equity. That's structure.
Yes.
Right.
Absolutely.
I think your comment about it, you should look at it like debt, is actually a pretty good one. I don't know what the rules are in the US, but like we actually have to record all of our preferred shares on they're in our books as debt. Like if you look at our company, we look like we have a ton of debt, and that's actually just preferred shares, because that's just how accounting rules work up here.
Okay. So, let's summarize what we've learned so far, because like Matt said, if you have no idea what we're talking about, this is the most boring episode on earth, but there's lots of really interesting things to uncover about the way this world works. And this is how like trillions of dollars of the economy work. So there's primary capital and secondary capital. Primary capital goes into the business, typically a VC thing, right? Secondary capital is when you actually, as a person, make money for selling shares in your business, right? Really a private equity thing. Sometimes VC does it, but a lot of times private equity will actually want to put some primary capital in your business as well. Okay. And then Jason alluded to this earlier, but that it's like, show me the headline and like, give me a valuation. I'll make a deal that works for you. I could sell Ridge for $40 billion tomorrow as a top line valuation number, but the deals would be horrendous, right? Where it's like I'm selling 1%, but they get 9 billion percent participation. Like, anyway, the top line valuation number just doesn't matter, right?
Yep.
It could, a lot of times it could be a negative signal because of how the deal is structured. And what Jason's talking about is like the most pernicious thing is the liquidation preference, where I could, like, let's talk about a company in 2021 where valuations were at all-time high. You could raise $100 million, right, in secondary capital on a $500 million valuation. Your company's worth $200 million today, right? Because the landscape's changed. That person has 200% participation. If that business sells for $200 million, they get all of it because that's the way participation is structured. They are guaranteed to get whatever their liquidation preference is. And there's even more crazy outcomes, right? You guys talk about coupons or notes. The money that they give you to buy your shares, right, or the primary capital they could put in, could also be earning a dividend like that happens above you, right? That's very, very common. So this is where like you really need a good lawyer. What's up, Jason?
Yeah, I was going to say, the one thing to note is people do these deals. They sound very potentially punitive, right? And very risky, and they are. But people are doing them because they are taking money out, right? So some people are just like, hey, I'm just going to take this money out because I'm taking enough out. And you know what? If the rest of my investment just doesn't work out the way I wanted to. So like, let's just make it out. Let's not make it out to be like it's all that awful. It's just just kind of know what it is. And those structured deals are very often you're taking money out. So if you're taking 50 million, 20 million, 100 million off the table and that's how you're not going to get the money out without a structured deal. There is no other deal. That's why structured deals are popular right now, because there ain't no other deal and you want to get money out. This is the way to do it. No, you just know the risks.
Oh, the other thing is, like, the reason why this is so aggressive in minority deals is because the private equity group doesn't have control of the business, right? Like, somebody could buy 25% of Ridge and then tomorrow I could say like, no, we're pivoting into being an ice cream company. And like, they would put up a big fight. There might be a lawsuit, but like, if we control the board, if we control everything, like they need some sort of protection, right? If you were buying something as a minority passive partner, you'd want protection too. And if you do a majority sale, you're giving up control of your business. You could probably get better terms on all of that. Like a dream private equity deal is they buy 51% of the business, right? So they're putting out the least amount of capital, but they still have control of the thing. And that's what gets you the best terms. But then you are kind of, right?
Yeah, it's I think what Jason's saying is, and what you're saying, Sean, is you're trading something, right? Like that's kind of how these deals get done, is like you just have to decide what's most important to you. Like in a minority deal, you're de-risking. It's like Jason's comment, it's probably good for you. Like most of your net worth is likely tied up in this business. You're taking some chips off the table. It comes with structure. Like you're still going to have to operate. They're going to get their money out first, whether that's another sale or just dividends, like just cash coming out of the business. They always get it first. Jason, are there other, like when you look at deal terms or structure, is there other things that you pay attention to? Like if you were advising a company who's like $30-40 million in revenue, they've got a private equity group that wants to come in and buy a chunk. What are some of the other things beyond preferred shares, right? What else are they going to look for? What should they keep an eye out for, I guess?
Like fundamentally, you got to work with these people, right? So
okay.
There's countless stories of people doing deals and then just being unhappy with the investors. So these guys are in business to make money, and even if you're not selling control, you're giving up a tremendous amount of control. So I think that's important, and that will be reflected in the deal terms. And I don't know if we need to go into like all the different terms, but like they have approval rights over all sorts of things that you want to do to run your company. So you may be like, oh, I still own the company and I control the board, but you don't control that much. And that probably goes with a lot of both PE and VC deals, but certainly with with these PE deals where you've taken a lot out, these guys aren't just sort of sitting on the sidelines and running and letting you run the business. They want to talk a lot. And so there's like tons and tons of terms that go into this kind of different minority protections and control rights, which, like Sean said, you need to get really good advice on it. Bankers, lawyers are both really useful. Obviously, a really good deal lawyer is absolutely paramount in doing this. But yeah, I just think you are probably giving up a lot more control than you think you are. And what happens is you kind of go down the path of the negotiation of these transactions, and you get all excited about the money and the valuation and all that. And then stuff gets sprung on you, or you just don't understand these things. So just realize that you're going to give up a lot of control, even if you still own a majority of the company.
Yeah, that's such a good point. There's like veto rights are really common when you do these deals. So even if they have a minority stake, like let's say they own 30% of your company, it's common that they'll stick in a veto on any other debt or equity deal that you do, right? So like you can't choose to go out and take on more debt. You can't choose to go out and sell more equity. They have complete control over that. They can put in even veto rights over expenditures. So like Sean, in your example, they might actually have structure in that deal which says like any expense over $100,000 or $250,000, whatever that number is, has to be board approved.
Yeah. So we're talking about a situation where you could sell 30% of your business and then you hate these people and you want to sell like the remaining 70% of your business. Yep. And they have the right to say no. They're like, no, yes. We get to sell first. Yep. Right. And we're not ready to sell yet. So this is why like the highest valuation might not be the best deal. And also why it makes sense to sell to firms that have good reputations, right? There's something like 5,000 private equity groups. Like they've really, really, really exploded. And there's a million people who would love to buy your business. But sticking to a company that has a really good, like a private equity group that has a really good reputation for winners and losers, right? Because a lot of deals do blow up and a lot of private equity groups go bankrupt. And that's typically actually a good investment for them. I wrote a whole thing about how bankrupting companies can make you a ton of money. But, you want people who act in your best interest, or at least aligned with your best interest through the good times and the bad times. So there's a bunch of great firms, and you talk to a banker and they'll tell you who the best firms are. Yeah.
And I think, Sean, that you should also, I don't know if you guys agree with this, but like if you're going to sell any part of your business to a private equity group, you should probably be looking at PE groups that have done deals in your sector, like in your industry. Like if you're a consumer goods brand, you should be dealing with a PE group who's done that before. Because like to Jason's point, you're going to hate your life if this is their first consumer deal, because they're going to ask you a lot of stupid questions and they want to talk to you a lot.
Yeah. I mean, do not sell to a firm that does like oil and gas industries, because they'll come in and be like, turn off the bad ads. They're like, stop spending money on the bad ads. Just do the good ads. It's like, I didn't think of that one. It's like, I'll just only run the good ads, bud.
Well, look, guys, I got to say, most of them are not very fun to work with. Like, it's like, definitely you want to, it's like the lesser of many evils. Like, who are you going to find to work with? Because your interests are just not aligned at all times, right? Like when everything is going well, your interests are pretty aligned, except they're like, they're going to find ways to tell you what to do, or because like they've got a bunch of really good number crunchers. I remember when I was a first year lawyer at Skadden and I worked on my first PE deal, and I was we were doing due diligence, and the PE junior PE guys, they're building the model, right? They're building the model. This is 1997, guys, and I'm in Texas. Okay, I'm staying. It was crazy, and I'm like, I was so enamored with and impressed with these guys going through all these numbers, and this is way before I became a banker, and like I was just so impressed with what they were doing, because I was a words guy as a lawyer and they were numbers guys, and the way they talked about the numbers and were able to analyze the business, and it all seemed really, really impressive. And these guys are all really smart, but they also are very, very similar. And they run like by a certain playbook. And if what your business is doing like is within the playbook, everything is good. But the minute something goes wrong, like it gets really, really tough really, really soon. So that's why if you have a business that's making a lot of money, you do the math, right? And be like, okay, do I want to take out X million now if I know I'm going to make that back over 5 years and like not have to deal with these guys in my shorts all the time? I know I'm going off on a tangent, but what I'm trying to say is these guys are all tough. And they're
Sharpest elbows.
They're sharp elbows and they're all really smart, but actually they're not as smart as you think they are. And so like be mindful of that.
Yeah, it's the they're really smart in their own lane, and now they're going to be in yours. Like they might be world class sprinters, and now they're going to jump into a swim lane, like they're used to running. So like, yes, I think it's great advice, Jason.
Jason, what do you like about Ceres? You were gone for the past week in Italy. Were you checking Ceres dashboards?
I wasn't checking anything in Italy, but I will say this: like whenever anyone on my teams, like growth team or anywhere else, like sends me data anymore, it's likely coming out of Ceres. And every once in a while, I'll get something from them, and it looks really slick. And I'm like, "Where'd you get that? Is that Ceres?" And like, yeah. And I always feel really good about our investment. I do get a daily email of some metrics out of Ceres that comes through, but one of the things that I've been thinking about a lot lately is AI. I mean, duh, right? Everyone is, duh. But like, I finally woke up a few weeks ago. I was like, I got to get serious about this. And I was actually talking to the Ceres guys, and they launched the next generation AI powered stuff in their platform, which I'm excited about. It's Ceres IQ. It's invite only right now. If you mention Operators Podcast, you can probably get access, hopefully. But the next level of all of this is first with AI, you need to have all of your data somewhere. I mean, it's going to be really messy to just drop stuff into different AI platforms. If you have your data in one place, and then you can really leverage AI. So the way I thought about our investment in Ceres Analytics was getting all of our data in one place, understanding our customers better, understanding our marketing metrics better, but then being able to layer AI on top of that is, I think, the really exciting next level here.
You brought up bringing in Costco, Amazon, and Shopify. The ability to have all sales channels with the same data is so important. If you're listening to this and you sell on Amazon, you know how painful that platform is. You have to wait like a couple extra days to pull your reports. Like the SKUs aren't the same as the rest of your SKUs. Like the titles are different. So like to get actually like clean data to compare, it's very manual. Using Ceres Analytics, they matched all that up for us. So like they cleaned all that data. So I could actually look at what is the true margin profile of an Amazon sale. What's Amazon return rate? What's Amazon customer frequency? Like all the type of data compared to our .com, and have like a comprehensive overview. And now with their new AI tool, I don't have to look at it. I could just ask it. It could just tell me cool questions. So doing that across our 5 Shopify stores as well. We have an EU Shopify store. So now I can compare EU Ring customer cohorts versus Canadian Ring customer cohorts versus Amazon Ring customer cohorts. So now we're getting to different functions of my business across different channels, different categories, and actually looking at the margin, the repeat rate, and like, is it worth investing in these different things? So if your business starts to feel like a spider web and just like keeps going and going and going, it's just like this nonstop proliferation of different channels, maybe it's time to check something out like Ceres Analytics.
I remember, Sean, at the very beginning, this is a very typical Sean thing. Sean was like, what is this? Why do I need this? Right. And I'm actually really happy that you come to understand like how important having a data warehouse is and what it does for managing your business, because you were not like a true believer from the beginning.
No, I was angry when you told me I needed to pay for something new, but Jason was right. He convinced me. He got me on board. I'm using it. So a rare Jason W. So thank you, Jason.
Very rare.
I'm on Ceres Analytics. He's on Ceres Analytics. Proud sponsor of the Operators Podcast. So if you want a data warehouse and you want an AI-powered data warehouse, tell Ceres about the Ceres IQ feature, and then you crave it. You're demanding you get access to it. So, all right, guys. Talk to you later.
Can you talk about the whole clock thing? Like, why did you say that a PE fund is coming in and they're out in 5 years. Like where does that come from? Like why do they have these timelines?
Well, they have funds and they need to return, right? They're always doing their funds have a certain life and they want to always go raise their next fund, because PE firms, they make money two ways. They make money on the management fees of their fund, and then they make money on the carry, which is the return on each of the investments. So they'll get, say, 2% of the portfolio each year. They'll get a management fee, and then they'll get 20%. The first 20%, they'll get 20% of the return on the fund, or on the investment. So they have to report. They have to. That's how they realize their profit as a business. So they in their fund documents they have life to their fund, and then in the deal terms they're gonna negotiate. Basically an exit, like that. They basically can force an exit after a certain period of time. And I think it's usually around 5 years.
Jason, is the, just for like people who don't know this, you're talking about the actual fund itself. So when a private equity firm raises a fund, let's say it's $1 billion fund, they get that money from LPs, right? Limited partners. That fund, whenever they sign the paperwork to form the fund, that fund has a timeline on it. So it's not specifically your deal that you do with the PE firm. It's the fund itself, correct?
Well, it's both. The fund has its own timeline. I forget whether it's 10 years or 7 years. It may vary based on the fund. But when you go out and raise money from LPs, there's a time frame for the fund, and so that therefore when they look at their investments, they basically need to provide for exit timing, unless it's like some family office that's not really a fund and they just invest in their own money because they can. But most like traditional funds, both VC and PE, they have a life of the fund, and so in their deals that they do, in their investments that they do, they will negotiate a guaranteed exit process, an exit procedure.
Yeah.
Over at a period of time where they can basically force a sale. We've seen that with one of our friends recently that went through a transaction, and it was like I think it was a timing issue. Maybe it wasn't a timing issue, but either way, like at some point they have the right to force a process to exit their investment.
I got bit by this once. Sorry, Sean. I didn't realize that, Jason. Like years and years ago, I was in a deal where I was an investor, and the fund that was the sort of like the main check, this private equity fund, I didn't realize that like they were very late in their fund age that they were investing out of. So they actually and it's important for founders to listen to this, right? So where they are in their fund life cycle matters to you, because this changes their incentives and how they do deals. Like if they're investing in your company and it's like year 8 of their fund, okay, and they're still trying to get returns for their investors, like how they behave with you is going to be different than if they were investing in year 1.
Yeah, there's a lot there. Actually, that's a really good point, because their whole philosophy will change over time, and I'm not sure like what the particulars may be. What happened to others, but they will view a certain investment and how they want it to go based on how well their fund has already done, for example.
Yes.
Or how much money is left in their fund. So all the things matter. Into the psychology of the investor and how they're going to behave with you. Yeah.
Sorry, Sean, you were going to say something.
Well, you guys brought up family offices, and I just kind of wanted to explain why funds act this way. And you have to put yourself in the private equity shoes. You're selling a product to investors, right? You're selling a product to LPs, and it's some sort of like, it's basically like a treasury, right? You're like, hey, we're going to take your money and we're going to deploy it in this strategy, and then we're going to give you, our target return is X in 10 years or whatever, right? So to the investor, it's kind of fungible. Like they don't really care what they're investing in. They just like, they are setting themselves up to have the money locked up for roughly 10 to 15 years or whatever, because there's a 7-year deploy period and then there's like a 7-year harvest period, right? And so you could get deployed in year 2 and harvested in year 4, but like it's something like that where like it pisses off the person who bought the coupon if they're waiting 15 years to get their money back, right?
Yeah.
So they need to actually return capital back, right? And that's why, like, you know, if you're in year 6 of a fund, you still have money to deploy, everyone gets very antsy because it's like, I need to deploy this to things that I can get my money back within 3 years, right? You have way shorter time horizon. So
yeah, it's also why right now in the market, things are so dicey, is because there's a lot of funds who've had no distributions, like they've not returned any capital to investors, and yet they're calling on for more capital later in the funds. Like capital calls is a whole other thing. We don't have to explain it, but you know, they're doing capital calls, and these investors are like, I haven't seen any returns. It's, you know, 6 years in, 7 years in, doesn't look like anything's going to happen. Like, why would I continue to put more money into this fund, even though I've committed to putting more money into the fund? So yeah, knowing your fund, like if you're going to deal with a PE fund, knowing the fund mechanics, right? How they underwrite deals, who their LPs are, their timelines, all that stuff. The more information you can get on who you're dealing with and how their incentives work, it's going to be better for you.
yeah, and then it's the reason why family offices, or, you know, it's also called permanent capital. People who don't have to raise funds, right? Sovereign wealth funds or anything like that. If you're investing out of your own checkbook, like, you could have a way different time horizon. Like L Catterton, which is owned by the LVMH family, like permanent capital, way different time horizon, way different goals of that fund. That fund is there to find, it's like the field teams that, like, they can actually pull people into the LVMH portfolio when they're ready, right? So it's like a scout program almost. So every fund's just like super different. You should understand that, like why they have different time horizons. But everyone's totally right here that, you know, if you catch a late fund, they have to return something in like 2 to 4 years, and they're going to be more aggressive than somebody in fund year one.
So Northbeam just launched Clicks and Deterministic Views, breakthrough attribution model that deterministically captures view-based performance of ad spend. This is huge. This means advertisers can attribute conversions and revenue to ad impressions and not just focus on one-day click. This is a really hard problem to solve. I'm so totally stoked that Northbeam is on. This new advanced multi-touch attribution model expands on their clicks-only model by incorporating proprietary in-app events from participating ad platforms. And these third-party events are validated by Northbeam's first-party pixel data, offering a more complete and accurate view of marketing performance. I just think this is so useful in today's environment. So many ad platforms have idiosyncrasies in user behavior that result in engagement metrics being more impactful on conversion than most conversion tracking software can measure. You know, platforms like Snapchat and TikTok, impressions are extremely important. Users are likely to click off of those platforms to make a conversion. But research from Snap and TikTok both prove that users have high brand recall off ads they've seen on those respective platforms. And rather than leaving the app instantly to make a purchase, the users are making purchases later, leaving conversions that are unattributed to ads without Northbeam CDV model. And so clicks and deterministic views are going to help you track the real value of your ads on more impression focused platforms. So check it out with Northbeam.
Yeah. So I think family office too is interesting, Sean, because I mean, I know that they play in consumer a bit. We've got a mutual friend who a lot of his cash comes from family office. And I'm starting to actually, I want to say, like in the last 2 months, I have heard of more. Because family office has a whole other set of incentives, right? Like they might buy a company because they want to own it. They want the cash flow for 20 or 30 years. Like they just might believe in, and they might be a sector investor, right? Like they just might own a ton of consumer goods companies or a ton of real estate or something else.
Yeah, I was just going to say that family offices are the most unique because it's individual people. Like what if they want to do? Like maybe they put together like a thesis. Maybe it's just whatever they think is cool. Think of people who are billionaires. Like they want to buy stuff. like it's very common. Like, you know, if you have a big exit, like you actually end up getting pretty depressed because you miss being in the game. So family office are just a way that like they could jump on calls and tell you ideas and you kind of have to listen to them. But look, there's really great family offices out there that have a lot of structure to them. It's always like weird people that you never heard of. Like I know with one, he's like the richest guy in Belgium. He's like, yeah, it's like they have like $4 billion. He's like, yeah, we're investing in a bunch of stuff. And then there's like a bunch of weird countries have sovereign wealth funds. Like Singapore has one, and they're trying to buy a bunch of deals right now. They think they bought that hat company, 57. They make like all the hats. Yeah. So they're owned by the Singapore Wealth Fund.
Yeah. I think that's the thing to note about family offices is there's not a lot of patterns, right? Like private equity, there's a playbook that they all follow within a range, Jason, I'm sure you'd agree with that. Like they kind of all follow the same playbook. Family office, man, you have no idea what you're getting into. Like each one is different. I've met so many family offices and every single one is different.
And those are just like way harder to, there's not as many of them. There are popping up. There's not as many of them. And they're just like, they're like the unicorn. They're great. If you could find the right family office that believes in your business, they'll be with you through thick and thin. And like, they're just that quote permanent capital. That's awesome. But I find that like a little bit of a pipe dream. A lot of these things are pipe dreams, right? But what I would like to go back to one of the things that we really didn't hit on, because we've been talking a lot about like the nuts and bolts of stuff, but I think a lot of people care about, hey, who's going to buy my business? What business do people do funds? Like, are they interested in? Like, we talked about it at the very beginning where Sean was commenting a little bit about like the state of the market. But like PE, they have a herd mentality, right? Like Sean's talking about them investing in service businesses now. They sort of find the sector that they like for whatever reason, and they all kind of decide, oh, this is where we want to be. And then they gravitate toward that sector, and it gets kind of weird, right? And like durables, ever since the mid-pandemic, consumer durables have been really not have been ice cold with PE. I would say starting in like early 2022, and has remained there. But we've seen a lot of really cool deals happen recently. Like Sean said, it's like a lot of consumables and packaged goods, etc. Because I think it's just really like easier for investors to underwrite that kind of deal where there's more like just more sales velocity and repeat purchase, and there's ways that they can do that versus versus durables or something it doesn't have it's not really a big LTV play, that it's really an AOV play. So like I think it's very binary right now. If you're like consumable or CPG, like congratulations, because like beauty and drinks and like there's a lot of like our friends Dr. Squatch did a deal and all these like so those areas remain hot. But peak like they and we talk about all the dry powder. I've been hearing about dry powder for like 10 years.
Yeah.
Okay. I've been hearing about the dry powder for 10 years. It doesn't matter. They're not going to do investments that they don't like, that they just can't get behind. And I don't know what happens to all the dry powder, to be honest with you. It just seems like people like the LPs, which are like big pension funds, like CalPERS and TIAA-CREF and people like that, they just need to put their money somewhere, and so they kind of put up with this stuff. But if you look at, and there's a lot there's this little area called AI right now, where like
it's eating up some capital.
Funds can deploy a lot of capital into that sector. So it's just like, rotating sector wise, and like, but fundamentally, there typically will be a deal for a good business out there. It may not be at the valuation that you want. And so there's usually a misalignment in that and in valuation expectations and what people want to pay. Like I'm sure there's a deal for Ridge out there. At a valuation, but maybe not at the valuation that Ridge wants. And so those are just a few things to think about. Everyone wants to know, like, everyone thinks, also like a lot of business owners will look at the most recent deal and look at that comp and they'll figure out a way to convince themselves that like they're the same. Right. You know what? You're not.
Yeah.
Okay. So what I wanted to bring up is that the ultimate buyer of all assets is the public market. And I know what that means is that everything has to IPO or be bought by a company that's traded publicly, right? And I know that we're in a weird period where Stripe and SpaceX and these companies can be worth $100 billion and not go public. That's just that is actually an exception and not the rule, right? So private equity is not the ultimate buyer of your business, right? Private equity is going to buy your business. What they hope to do is sell you or IPO you, right? Yeti was bought by private equity and IPO'd. Dr. Squatch was owned by private equity, sold to Unilever. What they're looking for as a private equity group is that there's a path for somebody else to give them more money for this asset, right?
They're
are not-
wholesalers.
Yeah. They are not in the business of long-term holding and cash flowing this business. They will in weird circumstances. They'll be like, oh, we just want to hold that thing forever. It's a cash cow, right? I heard about a company that sells school supplies, like science equipment to schools, and that it does like $15 million in revenue, $25 million in EBITDA, and they just cash that business in. They're like, we're going to have that thing for 50 years because that is like the secret sauce to that fund is that like they don't have to do anything else. They could just keep owning it. They'll probably sell it to themselves. So the actual general partners will buy it from the LPs just to have this like constant ever growing capital. Super rare. They want to sell your thing to somebody else. And if there isn't a good strategic or the strategics in that space are dying, like Jason's too big to be sold to a strategic. Costco would have to buy him, right? So if he gets bought by private equity, they need to IPO that business. It's the only path to get a return. Like
at a certain
They
scale.
look at and that's a big point. That's a great point that Sean raises. That they're looking at their exit coming in, right? Like that's really important to them. That's a big criteria that they're evaluating in doing a transaction. And so they're like, okay, who's going to buy? Who are the natural strategics to buy this? And the thing that they don't tell you is that like 50% of exits are PE to PE, or 50% of deals are PE. So they'll try to ding you or like find a way. They'll use that as an excuse like to not invest, to say, well, there's no real natural strategic buyer. And there's a ton of PE to PE trading out there. But ultimately, you get to a certain size where, there's no strategic buyer out there for you. So the PE, but that's kind of rare air too. Like we're sitting up in like the point whatever % of deals right now.
Yeah.
All right. Matt, you had cool things to say?
I was going to say my last company, when I sold it, we sold to private equity. It was part of a roll up. And then 3 years later, they just sold to an even bigger private equity group doing an even bigger roll up. Like that's very common.
Yeah. And is that company still owned by private equity? Hasn't IPO'd yet?
Still today. Yep. Yeah, that deal happened in mid 2021. The second exit was in mid 2021, and they still own it.
Yeah,
I don't know. I'm out now, so I have no idea what the plan is. Like that was my actual like final out.
2021 has made it very, very weird for deal math. Is that like we're getting on 4, we're going to be 5, it's going to be 6 years. Like those assets either need to be written down or they need to sell. Something needs to happen.
Yeah. I think I think that's a separate thing. I think there's a ton of venture dollars still sort of out there and marked at a value in consumer that I just think everybody's looking at each other across tables saying like, I don't want to do it. Do you want to do it? And it's just a weird game of chicken where like nobody actually wants to do that, Sean. Just because of the incentives of the actual GPs and the people that work at these funds, like it's not good for them if they have to go and like mark down their portfolio of consumer deals by half, right? Or SaaS or whatever else. Like it was all just a really stupid time for value. But the minute they do that, it makes their life so much more difficult, right? Like if and this is why it comes, like I think understanding the people, the funds or the firms that you're dealing with is so important, because that's going to govern their behavior with you. And I think like Jason brought up so far is my favorite point, which is like you still have, when you do a deal, minority or majority with private equity, you are working with them now, right? And they're going to add structure to that deal where you absolutely are going to have to work with them. Like this isn't some like ride off into the sunset moment. It's unlikely that you're doing that kind of deal. Like let's be clear, like you're, consumer operator. They're not running your Facebook ads for you.
Right. So I've never watched Entourage, so I'm watching it for the first time now.
Such a good show.
Yeah, yeah.
So good.
So I've never seen it, but I'm season 1 right now, and there's a line that it's like you should sign your next movie before your movie comes out in case it bombs, right?
Yeah.
And that's kind of like how like private equity funds work. It's like you want to raise your next fund as soon as possible. And so like if you had a fund in 2021, it's really like, oh, this is all overvalued. I need to find a fund. I have to raise a new fund before I mark this stuff down. So they were trying to close funds in 2022, 2023. Hopefully they close them in 2024 so that now they can actually write all that the previous fund down because they're set up for success now. They already have the money. Most brands are leaving money on the table with SMS. Not us at Ridge. SMS is our #1 revenue driver, and PostScript is the reason why. Here's the deal. SMS is an email. If you treat it like email, you're doing it wrong. PostScript gets it. They help brands like ours turn SMS into a high margin, high ROI channel. And here is 5 reasons why PostScript prints money for us. They stole the 5 reasons why landing page from all the D2C operators, but here you go. 5 reasons why PostScript print money for us. 1, we stop wasting sends. Blast and text randomly, bad move, expensive move. PostScript dialed in our automations and subscriber LTV tracking. The results, our abandoned cart recovery rate doubled. They told me that. They did the data. It doubled. More subscribers equals more cash. List growth isn't just about getting numbers up. It's about getting buyers in. PostScript's AI pop-ups and cashback incentives powered by Fondue grew our list 3 times faster. And those people are actually spending money. AI-powered SMS equals instant conversions. Customers don't wait around. If you're not answering instantly, you're losing sales. PostScript AI does the heavy lifting. We went from hour-long response times to closing sales in seconds. And hour-long response times are actually best in class. We have an amazing customer service team using Rich Panel and other awesome tools, but it still takes hours to respond to all these people coming in. With AI-powered SMS, we're getting instant conversions. The #4 reason why PostScript is the king of SMS. PostScript auto-optimizes for profit. They have this new thing called infinity testing. It consistently finds the best messages to send. No guesswork. We saw a 20% revenue boost just by letting it run. #5, we're not getting fined. 1 SMS compliance mistake equals a lawsuit. PostScript makes sure we don't mess this up. We scale without worrying about legal headaches. The bottom line is brands are winning at SMS and growing faster than anybody else because they're using PostScript. If you're serious about scaling up, go to postscript.io, tell them Sean sent you and get a free SMS audit. Your competitors are going to do this. If you sell pans, they are rushing right now. So if you're not on PostScript, you got to get here before your competitors. Get that free SMS audit. And the results for Ridge in 2024, we had 1 million opt-ins. We had 500,000 new subscribers. Revenue was $37 million, grew 100% year over year just on SMS. The ROI, 108x. This is a 151% increase year over year. We had a 106% increase in revenue, 108x ROI, and close to 500,000 new subs. SMS is killing it for Ridge. We think PostScript is the way to go. We think PostScript is the best name in SMS. They have a 5 reason why. They're not going to waste money on send. They're not going to leave your customers out to dry. You're going to get more subscribers. They're going to instantly convert them with AI. They have auto optimization for profit. They're going to keep you compliant. I think SMS is still the frontier of messaging to customers, and PostScript's the best name in it. Ridge did $40 million in SMS last year. This year will probably double again, $100 million in SMS probably because of PostScript. Thank you for sponsoring this podcast. Thank you guys. Talk to you later. But anyway, this has been a lot of nerding out. Let's get to the tips section. Matt, you got any tips?
It's going to take, here's a good one. It's going to take longer than you think it will. So when you start the process, right, however long you think it's going to take you to find a buyer and however long you think it's going to go, it's going to take from the point where you sign a term sheet to when a deal closes, it is going to take longer. It is going to be more painful than you imagine, and the deal is likely to retrade at the last minute.
All true.
Okay? All true. Did I get that right, Jason?
Yeah.
All 3 of those things are probably true.
Like the issue here is unfortunately, like we're not the bearers of good news here. It's like these things are really, really hard. I always said that when you have like an agreement on price or a term sheet or whatever, there's still like at least 50% chance that the deal dies. So don't spend the money. And I would say the best thing to do is sort of try to create some kind of competition, or like I have a whole bunch of like these things in the Panzerisms, right? Time kills all deals. Like build a business you want to own forever. Like there's a reason why I've been saying these things like for my entire career, haven't seen all this. So like the advice is like we've given all kinds of these, like build a really strong business, and then use professionals. Don't be penny wise and pound foolish, and take the money. Like don't just over negotiate for the last penny, because I've seen the M&A landscape is riddled with people that turned down a deal, and that was actually a good deal. And at the time, and they thought they could get more. And not only did they never get more, but they actually never did a deal. So that happens. That kind of stuff happens way more than you think. So you just like, you got to be incredibly realistic about this process. It's really, really hard. It's really, really time consuming. It's a major time suck. And the other thing I'll say is like private equity firms and VC firms, institutional investors, they all love you until they don't. So, I used to get like the emails all the time. Oh, I still get like these ridiculous people like saying they want to buy Hexclad. I'm like, dude, did you even Google us? Like, do you have 2 billion? Like, you don't have 2 billion. Like, what are you talking about? Like there's a bunch of junior people that are paid to reach out to you. Like that's their job. They're just sending out emails. And so they all love you. They all love you until they don't. Like, just really trying to waste your time.
Okay, hang on. That's a really good tip. This industry has a lot of people that are employed to waste your time because that's their job. Their job is simply to get you on the phone and get to know you and talk to you, even though it's like, I think Jason, you said another thing that's really important here. The chances of you getting to a successful exit is so low. It is such rare air. And this is for any deal size. Okay. If you're listening to this right now and you have dreams of selling your company, like you are playing a game of lightning strikes. This does not happen often. Like in the math of like how many businesses get started every year to how many ultimately get bought, that is a crazy low number. You're probably better off just building something you want to own. I think that's really good advice.
This is the thing that drives me crazy, Matt, is like people literally, they start a company and the first thing they're thinking about is like, how are we going to sell it? It's like, no, start a company that you can make money. Like if you're not thinking about how do I make money right away, especially in consumer. I used to see this in tech all the time because I was a tech banker, and again, there's like a million companies that just like never got a deal done. Millions, but this whole like, oh, I'm going to start a brand and we're going to, we all meet people like this.
Yep.
Right. And I'm sorry because I might be, there are probably a lot of people that listen to the pod and who are great people, but they're thinking the wrong way. Like they're thinking about it this way. And it's just like super rare that this is going to work.
There's I got another one. If you guys are cool with it, I think in consumer, this is actually an important one. The age of your brand matters a lot in the value of your brand, right? So if you think you're going to build a company and sell it in 2 or 3 years and get like maximum value, you just took really bad odds and made them 2 orders of magnitude worse. If you're old, I think there's like a magic age in consumer. Like you need to be over 5 years old. If you're not over 5, and actually ideally closer to 10, because that means that you're sort of enduring and durable and you're actually more attractive. So I think this idea of rush to exit, Jason, is really important to call out. So even if you have dreams of selling, you shouldn't be coming into this game trying to get in and get out in sub 5 years. It's just such bad math. Like go get a better job. It's better math.
Yeah. And I wanted to give it an advanced tip that I think we skipped over that we should have talked about. We should talk about like the economics of a leveraged buyout and how you can recreate that with a debt recap. So
that's a great one.
We talked about private equity buying your business, right? Private equity raises a fund. A lot of times what they do is they deploy a small percentage of that fund into your business, and then they put debt on your business to buy the rest of it. So how does this work in practice? I have a $100 bill. You're going to buy the $100 bill for $110. You only have $20. You're going to give me $20, and then against the $100 bill, you're going to borrow $90. Okay. You've now created $110 of purchasing power to buy my $100 asset with only $20 down payment. Right. And the idea is that the $100 can be put to work to pay back the $90 over time. I'm sick, so hopefully what I just said made sense. But
yeah, it does make sense. Like when private equity, the reason where private equity came from was the LBO world. Like this is really where it started in like the 80s. Read Barbarians at the Gate, great book. If you want to learn about the history of this, it's the RJR Nabisco deal, and KKR, but it gives you like a lot of the history of LBOs and private equity. But essentially, yeah, they're able to borrow money based on your cash flow and pay you with it. So you can, if you have a good enough business with enough cash flow, you could essentially do that yourself in what is often referred to as a dividend recap or something like that. And we've done that. So basically, you can find a bank if you have a stable enough cash flow stream and if you're big enough to lend you a multiple of your EBITDA, and you can take some or all of that out at a low multiple. A private equity firm, in the like when in a really hot market, private equity firms will be able to get like 6 or 7 times leverage on a business, and so they're putting up very little cash.
Okay, hold on. So let's explain that.
Okay.
You want to buy a $60 million business. You can put up $10 million, and then you can get the remaining amount of money from the bank, right? And that's how many turns you can get, how many turns of EBITDA you can get on this business. So when Jason says 6 to 7 times levered, that's incredibly aggressive, right? Like the modern multiple is 2 or 3.
Yeah. Well, I would say for PE, in a PE deal, I would say the multiple is more like 3 to 4. I would say like super conservative leverage is like 2x. And so, banks don't like doing that for founder-owned companies, by the way. You have to have a really strong business to do it. But if you do have a really strong business, you can essentially be your own PE firm. And you can like keep doing it, right? You can just, every couple of years you do it, and you take money out as long as you have a really good track record of stable cash flow and making your payments. So you could do like we did 2x. We did a 2x one last year, 2 times EBITDA. I think it's pretty. People know about this. We've talked about it before, and it's no problem. I wouldn't do more than that, because it's just like we don't need it and it's a headache. So, but I think a modest level of leverage is actually really cheap money too, right? At rates today in the, call it like 7% range or even 8% range. Interest is tax deductible. So if you're profitable, like your effective interest rate is like half that. So you could borrow that and go invest that if you're a smart investor and probably make an even better return. So it's actually good. It's good financing.
Right. And going back to the fundamentals of this, if you're selling your business, it's because you value cash today versus cash in the future, because you're not selling your business unless there's cash flow tied to it. That's the reality. If you don't have actual 2 to 3 years of profitability in EBITDA, right? Unless you're the extreme outlier growing 300%, like unless you're profitable right now, you're not going to sell your business anyway. So if you're selling your business in this market, it's because you value cash today versus cash in the future. Right. That's the math private equity is counting on, is that like you want the money today, they have the money today. Now, if you believe in the long-term cash flow of your business, what you can do is you can get good relationship with a bank and you could do a dividend recap where you're doing a leverage buyout of yourself, basically. Right. So they're going to give you your business $50 million in loans. You're going to pay out $40 million in loans. You're going to keep $10 million on the business, and you're going to pay that back over 5 to 7 years. Typically, you just pay the interest, and then there's a balloon payment due at the end, and then they just have you refinance and you do it again. So instead of taking out 50 in 5 years, you take out 85, right? And that's how the bank's really happy doing that, because they love the free money, right? They're in the business of lending out money. And now you're hooked with them until you go out and sell this thing. So leveraged buyouts are a tried and true tactic that they're going to do to your business anyway. You can learn about the power of leverage and you can do it to yourself. That's just like the advanced tip I want to tell you guys about.
That's a great one. That's a really good one. Can we talk about bankers real quick? Because I think this is another thing that I didn't realize until I started working with bankers, and I've worked with a few now. Bankers, Jason, let me start with this. Jason, what is the job of a banker? So like, let's say a company is fortunate enough to be big enough that they can get an actual good bank to represent them for a minority, whatever the deal is. How should a founder look at that bank, broker, whatever, okay, as what are they going to do for that founder, for that operator?
So the banker is going to prep the company, is going to create marketing materials about the company, and is going to reach out to all of the potential buyers / investors, and manage the whole process. They'll do like the marketing materials will give a bunch of information. You'll sign NDAs to send marketing materials, and start with a teaser, and then you'll sign an NDA, and then they'll provide a book, an information memorandum, and that will tell them a lot about the company, and they'll solicit indications of interest, and so they do a ton of the heavy lifting, and they create competition in the process, and then they also there is a ton of work in getting a deal done, and because the bankers only get paid really if they close a deal, they're incredibly motivated to help to get everything done. There's just so much work, right? So you'll have a banker and a lawyer, but the banker is the marketing arm and the lawyer is the execution arm. But actually the banker is marketing, execution, and the lawyer is really execution and risk analysis, right? So,
yeah,
it's really like all that upfront work of prepping you, of doing a model, doing a book, and then reaching out to all the parties who you guys all agree are worth talking to about a transaction, and then doing a bidding process, negotiating with the bank, with the bidders. Hopefully you get multiple bidders. Doesn't always happen, but it's great when you can get multiple bidders and play them off each other. Like bankers know how to do that. Bankers are pretty shameless, and you need that those shameless people to sit there and talk a good game about everything, to create interest and maintain leverage in the process.
Yeah. And I think the thing with bankers, at least in my experience, is they do an immense amount of work when it comes to like the process and the outreach and the competition piece. You're still, as an operator, you still have to sort of be deal ready, right? So like they're not going to come in and build out your data room for you. Like you are still they're going to tell you what you need, right? But like your team and you are still going to have to do all this work to make your company like truly saleable, because they don't know your business that well. What Jason's talking about with model is they're going to take what you have and they're going to go and build this like future looking, really beautiful model of like, here, Mr. Buyer, once you own this company, this is what it's going to do for the next, 5 years or however long. Am I correct in saying that, Jason?
Yeah, I think that's fair. You have to definitely be a very active participant in the upfront part of the process. Once the bankers take the business to market, there's a quiet period where they're sort of doing all their work and they're reporting to you how that process is going. Then eventually you'll have to meet with interested parties, and that also takes up a lot of time. So, but yeah, you have to be ready. I mean, the bankers, when they do the go-to-market prep, like building the model and writing the marketing materials, they definitely they do a lot of heavy lifting there, and they leverage what you have. But actually, they will give you work, right? Because you'll uncover during that process all the that you haven't done, and it might even be like, hey, we got to put this on hold because you're just not prepared, right? So there's a ton of work all throughout the process. The bankers will handle a lot of, once you decide, hey, we have a deal, there is a ton of due diligence, right? And that's one area in which the bankers are really helpful in like managing that due diligence process. It is a lot of work, and you could be due diligent. You can be getting diligence by 5-10 different potential partners, right? And that diligence process is I remember when I was a banker, like we just got deals closed because we refused to quit and we just kept pushing through due diligence. But like, if we were lazy, there would have been a reason why like many of our deals just never got done. But we were super motivated because if we didn't close the deal, we didn't get a fee.
Bankers are like the elite level salespeople. They're like the highest level of being a salesperson. Like they start off with like selling phone kiosks salesman, and then it's like, you're doing SaaS, and then like, bankers are like top of the game, right?
Don't skip Cutco, dude. Like, you got to sell knives door to door, vacuums first, and then you get to go be a banker, man. Like
like kudos to I appreciate you saying that, Sean, having spent 12 years in doing that, but like kudos to bankers in the sense that they are the elite salespeople, but they also have to be really skilled at other things. And when I became a banker, I was really good at like the transactional side of things, but I underestimated how much sales and marketing skill you needed to have to be a really good banker, both in creating the materials and bringing in business. These bankers not only are trying to sell your company for you, but they're trying to get you as a customer, trying to get you as a client. It's hard.
And do you know why that job is so difficult? It's because if you sell a business, you could make $4 million in 1 year, right? Like, it is one of the very few jobs. It is like brain surgeon, it is partner at a law firm, and it is banker, right? Like, it's normal doctors make like 300 grand. So like, if you're a good banker, I was reading the top M&A lawyers in New York were making like $40 million a year, right? If you're like the best of the best, like, you could make $10 million on one deal. If you're doing the, Figma Adobe merger, I mean, that got broken up, right? But like, if that would have went through, the commission checks on that are $1 billion going around, right? So it's like $1 billion. Now, like 4 firms have to split it, and there's a bunch of people in those firms, but it gets insane very, very fast. So, it's great work if you can hack it, but it's not easy. I mean, there's a reason why bankers get divorced, right? It's like, it is 80-hour weeks. It is planes. It is meeting people in person, shaking hands, trying to get deals done.
It was an absolutely punishing job, I must say. I was really interested in doing it when I transitioned into banking from the operating side, and the amount that I learned was incredible, and the skill set that I developed was incredible. But I don't advise doing that job, man. It's because you also have to have that characteristic of being sort of shameless too.
Yeah.
I think, Jason, too, like, you being a banker, as hard as that job is, like, it's the reason you're in the role you're in now and doing some of the deals and some of the things you have. Like, I have done so few deals in my life, and I've even raising money, like, we've only done it a few times. The amount of minutia that I'm aware of now in how a deal gets done, I just, like, I can't imagine how, if you've done 100 deals, how many little weird terms things you've seen, like from share sales to asset sales to like employment agreements and non-competes and all these stupid little things that come with getting a deal done. And I don't know if anybody, like, it'd be fun if you you're listening to this show, try and get your hands on a purchase agreement, a share purchase agreement from a private equity deal, and just look at all the that's in there, or ask, maybe AI can spit one out of like the typical. These things are not like 2-page documents.
100-page document.
Yeah. There's a lot, like, when we're giving you the high level structure of things right now, but there are literally dozens and dozens of little minutia things that are going to be important to you. They will impact your life and your happiness post deal.
So I was talking to a fund yesterday, really great fund, top tier, crushing it, right? And they're interested in a minority deal in Ridge. And like I've said publicly, we're years away from doing something. I think we're years and years. But talk to the banker, young guy, probably my age, maybe even younger, great shape, balding. And it's like, that is what happens if you're a banker. Just, it sucks the life out of you, right? Like it'll take your hair, it'll take your sleep, it'll take your life.
But there's big upside. I mean, if you're good, like you said, really big upside if you're good. I'm actually so much better at being a banker than I am at doing this job. It's crazy. Like I've forgotten more about the deal game. I love doing deals. It's it's a hard job.
Can I ask you like a tactical question? Because I think I saw this come up recently. Audited versus review financials, Jason. When do you advise a brand, a company to start doing audits?
Like I think if you're over 20 million in revenue, if you're 20 plus million in revenue, you should just do audited financials. It's really not that much more money. If you're making that kind of money, it's like a drop in the bucket to pay the extra. I mean, I think our first audit cost us like $60K when we were 50.
Yeah, dude. My reviews are 80 grand now. My quote for an audit was like 250,000. So I don't know where.
That seems high.
Come on.
That's what I'm getting quoted. So I've just done reviewed financials, but Jason gives me about it all the time.
He should. You can't sell a company with review financials.
Yeah.
Are you talking to like a big four firm? Are you talking a big? Look, we did our first. Okay, I'm talking about 5 years ago. Right, we did 5 years of audited financials in 2020. We did our first audit with. They're a good firm. They do a lot of retail. They've got office in LA and other places. I cannot. You got to be able to do an audit for $100,000. You got to be able to do an audit for $100,000.
Make the intro, dude. But we did. This is all over reviewed financials, and they just got bought by like a multi-billion-dollar deal. They just got bought. They're rolled up with somebody. But if you're listening to this, dude, $100,000. That's the going price for audited financials.
No, block them out too. Or actually, just not. That's not really a referral.
All right, boys. Fun chatting as always.
All right. Thanks for making it all the way to the end of this episode. Wherever you are in the world, it is awesome to have you here. If you do not already subscribe to this show, that is my one ask, is please go to whatever platform you are watching or listening to this on. It could be YouTube, it could be Spotify, Apple, I don't care. Just go hit the subscribe button. Please pump our egos up. It helps. And before we go, one more thank you to the sponsors, Fulfill, Postscript, Northbeam, Ceres, and Rich Panel. Awesome guys running these companies. We all use them. These are our vendors. That's the only reason they're sponsors of the show. So thanks again to those people.